Welcome back to a new episode, and today we're going to talk about the commodity markets, and we have a very special guest joining us from Switzerland named Alexander Stahel. Alexander has done research and investing in commodity markets for several decades, and today he shares his biggest lessons learned so far. We'll talk a lot about commodities, and we're also going to talk about how Alexander finds great companies to invest in. So this is a long conversation. It lasts for nearly 2 hours, but I promise you, if you join us for the whole conversation, you're probably going to learn a lot of new stuff. So let's start the show, and I hope you enjoy this episode. Let me just start the episode in a funny place. Why do you mention avocados on your Twitter bio? What's like the thought behind it? Is it because you see so many avocado toasts all over the world, or I know you have a message behind avocados, so let's just start there.
Look, we are in this climate debate, right? I shouldn't say debate, because the IPCC has decided that if we increase global temperature by 1.5%. This is the budget we have in terms of CO2 to get there. And then we don't know whether, call it human life changes as we know it because of climate change. And then if you assume 2% of degrees is makeable, then it will change in this and this way and so on. And no one knows, of course. We cannot know these things, right? But so there are a lot of people, and then the European Union, don't forget, created a climate law based on that, and most nations out there, including China, committed, although some of these commitments are clearer and some of these commitments are not at all clear. But if you go to the fine print, but what I'm trying to say here is, it really, people take what came out there very seriously, and they want to help and contribute in their own way, which is fantastic, because people are fantastic. I think most people out there, they really want to help. Well, the thing is, that debate, I think, leaves a lot of people now with a very strong heart and a lot of passion, but it may not allow them to understand why we need fossil fuels, because that's an important part of our modern life. It's actually what modern life is built on, hydrocarbons. And if everyone is so, then I have a certain type in mind that you and I can see visually in front of us, that is there and tries to be what I call a good doer, and has a very strong opinion about this climate change, and at the same time is enjoying her or his avocado toast. Right? And that's where it all becomes awkward, because the avocado really needs a lot of fertilizer to be that beautiful avocado, and not just a little crampy little nothing avocado. And that avocado doesn't grow in Norway or in Switzerland. It actually comes from different places around the world that have the climate for it. And that means you have to transport it there. And then you have to harvest it. And all these things, if you go through them, I'm the kind of guy who likes to go through these numbers. And if you do these numbers, and I've done them now for, something like 20 years, you just understand what the carbon footprint is of an avocado. And it's an enormous footprint. I mean, it's like the one fruit that if I be the good Tsar of Europe, and I would say, okay, if we really want to do net zero, then sorry, the avocado is out of the supermarket. Eat something else, right? Go back to the local nutrition card that you have in Norway and that we had in Switzerland in the 50s, because, it wasn't normal to have a banana in Coop or Migros or whatever the supermarket is where you come from. So I think people take a lot for granted these days. And then at the same time, they have very strong feelings, opinions about another aspect of life, and they want to go from A to B overnight, immediately. And that's a very dangerous thing.
If I can just
and what I try to do actually on Twitter, I think more than anything else, of course, I tweet about all sorts of things related to commodities, but if anything in the future I could achieve, it would be to find the right way to educate as many as educate sounds like, oh, I'm an educator. I don't want to. I just like to bring it across so that people reflect and note more, be more conscious about what they are actually doing and what they are actually saying. And that often there is a wide gap in between. And if we can close some of that, then I think we are on the right direction. And also to think for themselves, because I think another thing that happens out there is that we all come from this strict educational system where we have to kind of go to school and, from 8 to 5, and then we have to go to high school, and then we are in gymnasium, and then we go to university, and we're doing this, and then you come out and then you work, right? But what happens there in the process is that many stop reading, stop learning, stop educating themselves. And I think that's obviously, I'm not quite sure about the generation now, because they have such a different access to information than I had, in the 90s. There wasn't much internet in 96 when I started in investment banking, right? There was one person had a browser, and we had to go there to that central computer. And then you would go there and there was nothing, right? You couldn't find anything on it anyway. You would go to some company website because you had to look something up and there was no information.
Definitely.
So it was a very non-digital world still in 96. And today, obviously, the access to information is completely different and so on. But there is the issue of fake news as well. And then some people get into the habit of just doing social media and so on. But, the good old world of books, where a lot of people took a lot of time to explain the world. And, if you're into books like I am, then I would suggest to your audience to read this book. If you do nothing else for the rest of your life, but if you read that, you probably know more about this debate that is currently ongoing and that will, massively form our lives for the next 30 years. Than anything else. This Pimentel guy really understands it. It's almost a science book, but it's really, really a good book. And I think, if we can help people to understand a bit more that the sandwich doesn't come out of the fridge, but it actually means that we have to go through a whole value chain, supply chain of human action that involves a lot of hydrocarbons every single day. And that system is very fragile, and it was built starting with the invention or the finding of oil first, in the late 19th century. And then since we were able to create the world that we have, and if you go back a little bit to the numbers and see like, wow, when President Kennedy was inaugurated, we only had 3.5 billion people, and we are now close to 7.9 billion people. The reason we can support that growth of people is because we have this modern way of doing things, meaning we use fertilizer that allows us to grow wheat, soybeans, corn, that constitute the main call it diet for 80% of all countries out there, gives us the proteins that we need, and without those we couldn't support the population we have. I mean, that's the kind of where it all should start, this debate, because in a way what we're doing here by kind of making hydrocarbons the bad guys, right? When actually they provide the life that we live, is kind of a schizophrenic very dangerous debate, because if tomorrow, the hydrocarbon industry, take anybody who produces natural gas, say enough is enough. I don't want to be the bad guy. I'm actually the good guy here. And they would turn off the taps. This world would be within weeks in complete chaos. And especially the poorest of this world. And this is what concerns me so much. In Europe, we are so, although we consider ourselves to be anti-fragile, I think fragile. I think we are actually anti-fragile. We have such a robust system. Our cities were created, before we even knew hydrocarbons were there. And so everything we've done means we use very little of it, right? We consume a quarter of it compared to the United States, the cities of which were built after we found hydrocarbons mostly, and therefore they are much bigger. For everything you need a car, they have a completely different way of life. So Europe is actually in a very good spot, but yet we kind of strangle ourselves in a moment in a debate between climate crisis tomorrow, which then becomes a fixed data point. I'm going to come back to that in a moment, because we had many of those in my life already, which, by the way, remains an assumption. And the outcome of which, right, what does it mean when 2% plus is then really the world breaking down? And there are good books about that too. And then we have to, therefore we need to change our way of life, of the industrial life on the hydrocarbon side, and that may cause a food crisis. But that food crisis is not in 30 years. That's in 2023, next year. So we have to be a little careful here, and I think we have to, as people that like reading and are into those topics, we have to we have a duty to pass on as smart and as good as we can the knowledge we have, to make everyone at least a bit more aware, or help them to be more curious about these things. Then, we also come out of these 10 years of tech. Everything tech, right? We had the same boom between 96 and 2001. And so it seems to me that the world of molecules is completely left behind. And the world of bits and bytes is in the middle of everyone's heart and mind. And everyone wants to be create the next shopping app, instead of, when I tweet, I say, are we short shopping apps, or are we short fertilizer and wheat and, corn that is actually going into your shopping? And that is, if I would have said all these things 2 years ago, everyone would say, that guy doesn't know what he's talking about. Now we go through the process, painfully so. And I think it's going to be it's going to be in certain parts of the world, mainly for the poorest, the Bangladesh, the African high population countries that also depend so highly on like Egypt depends so highly on imports from Russia and from Ukraine. So this war, in addition to the hydrocarbon crisis that we already have, creates a perfect storm also in food. So it's everywhere, wherever I look. And it makes me at times also very nervous, to be honest, because I see already now that the price behavior is dysfunctional in many parts of the commodities in the real life, with the guys that do it, the trading houses, and they are all very concerned. And I think we should be too, and we have to be now very careful with our ongoing policies, in my view.
Today, there are apps for basically everything. Planning your day, ordering coffee, booking a taxi, working out, cooking, ignoring, commuting, getting directions, connecting. While the world moved on, investor relations didn't. Even today, finding relevant information and connecting with the companies you care about is time-consuming and analog. Until now, because now there's Quarter.
Nice.
Quarter, bridging the gap between companies and investors.
perfect segue to a very big debate, especially it's often a debate in tech as well. Do we believe in that we can create abundance in energy and food just given that we have the right innovation and technology, or do we believe that it's going to be a resource management play where we have these resources, we're not going to invent a new oil, let's say. So it's all about, spreading this energy as efficient as possible. Or do you believe that we have great discoveries which actually can create abundance on an energy level? Or is that just an impossible question to answer?
Yeah, this is probably a little bit out of my league, but let me try and say a couple of things that I feel comfortable to explain. So first of all, let's take the electrification of everything. The electrification problem of everything, technology, non-technology, it's chemistry. And in chemistry, because batteries are chemistry, lithium-ion battery is a chemical problem, and we are trying to solve chemical problems in battery, meaning making them more efficient, having a larger range for the car, and so on. We're trying to do that now for about 30 years, and we're not making a lot of progress. So Moore's law that applies to the semiconductor industry and that made everything, that was computerized so much more powerful, doesn't apply in battery technology. That's going to be, and there are some very good informations out there. I mean, if you go on Volkswagen Power Day and you spend 90 minutes on that, you can learn a lot about batteries, and it's nicely presented with a similar accent than I have, but I think people will understand it. And the point is, it's hard. It's really hard. So let's be humble about what we can and cannot do technology-wise, so to speak, in terms of the transition. But then it goes a step further. Then we go into the materials that we need for that. So the nickel and the lithium and the copper and the cobalt, that each have an important function in a battery. And those, while not scarce in Earth's crust, very scarce in terms of production, meaning everyone, do we know where the deposits are of copper today that we need to bring online in order to supply the additional demand that will come from the electrification of everything, not just cars, windmills, the solar panels and so on. They all need copper because copper is the amazing conductor of everything, right? It conducts best. The best conductor of all the metals is obviously silver, but silver is so much more expensive than copper that it's impossible to substitute or to be used. And then the next best conductor is aluminium, but the aluminium in an industrial application has a lot of disadvantages. It's brittle, it doesn't like water reaction. So if you use those underground cables that the offshore wind industry now needs, and if you go to ABB, which you obviously know, it's a Swedish-Swiss company. They do everything when it comes to cables. If you go and talk to them, they really don't like to use aluminium because the maintenance part, maybe in 10, 20 years, which matters to the overall life perspective of a wind farm, is very hard to do if you use aluminium. So there we could go into a lot of details, but believe me, no one wants those mines. So America, for instance, has 3 incredibly interesting large-scale projects for copper. None of them gets anywhere, right? There is a project called Pebble, which is in Alaska, which is run by the way, listed company, Northern Dynasty. You can look it up. They are in a permitting loop now for 15 years. And when I say permitting loop, they don't make an inch of progress. Now, if you go and really go about the details, as this is exactly what I do, and really look into these things, what's going on there and so on, it's actually shocking what what kind of red tape there is, lobbying there is to kill that project for no reasonable reason. And at the same time, we want that electrification, right? So what we are trying, in what we put in law and what we are actually doing on the ground in these administrations, that couldn't be further apart. And so we have to make some decisions and say, look, either we want this electrification, which I have nothing against. I think that, electric cars are cool. I bought my first Tesla in 2013. I think we should buy them. Why did I buy them? Because I'm concerned about the supply of oil. I'm not concerned about the demand of oil. I'm concerned about, this tank, which I call Mother Earth, at some point in 100 years will not give us the 105, 110 million barrels we need. And so we need alternatives, right? So I'm all for that. From a different angle than most people, everyone thinks that we need to get rid of that diesel engine. I'm not worried about the diesel engine. I'm worried about where does the diesel come from in 50 years. And we're going to have, by the way, the first diesel crisis this summer for your audience. If you don't believe that, we absolutely are going to have a diesel crisis this summer. I think we're going to have curtailments in diesel. Imagine that in Europe. So we had it in the 70s. We're going to have it this summer. So my point is, it's just that we have to become somehow as citizens more aware of what is going on here and how contradictory this planet at the moment is in its behavior. So the net zero carbon law in the European Constitution, which forces the entire car industry to electrify everything by law. So it's compliance driven. Okay. And on the other side, no chance to bring on a major new mine in America, the not in my backyard syndrome, which means, so where does the copper come from? And that Volkswagen and BMW and Renault and Mercedes need in order to, Mercedes, for instance, wants to electrify its entire global fleet by 2030. Audi, according to Volkswagen Group, wants to electrify all Audi cars by 2025. Now I say that's fantastic. It's cool. These cars are actually, if you sit in the e-tron, they're really cool. But I'm just saying, I'm a resource investor, and I'm thinking like, maybe the Fondquant family office wants to call me to negotiate for them one or two deals, takeoff deals, because I'm not quite sure where they want to source the copper. There are big challenges coming, and those challenges, at the moment we have called it fossil inflation, right? The inflation because of fossil fuels, but in parallel that we're going to have greenflation, so the inflation because of metals and minerals that we're not going to have sufficiently, and they're going to therefore increase in price. And the second is probably what you feel less directly, because the fossil fuel inflation you feel in your heating bill, and you feel it in your, at the pump when you fill up your car right now. But the mineral inflation you're going to feel when you pay the car, because it's an Investitionsgut, an investment good, right? And then when your electrified car, your e-tron, needs about 4 times the amount of copper than your current car, same size, and the copper price doubles or triples in order to set the incentives to find each mine out there to have enough copper in the future. You're going to feel it too at some point. You're going to feel it less, but you're going to feel it too. And that comes in everywhere, wherever I look, it comes in now through the fertilizer, through the copper, through the nickel. We had just had the nickel short squeeze on top. Wherever you look, wherever, and we are so deeply into the commodities. The commodities, as I like to say on Twitter, they are angry. And then come the macro guys and say, no, but you don't understand. We are in a slight deflation because, and they look at their CPI components and think this is coming down. And I'm thinking, well, I have a different perspective because I do commodities, and one part, obviously, they think about demand and demand becoming less. And that was true for the last 10 years. Whenever they saw a demand slowdown, that mattered for commodity prices. But the thing is, the supply side at the moment is hurting, a multiple time more. We just don't know where to bring on the supply on anything. On gas, European gas, huge problem, right? And we can go through the numbers for your audience if you want, but maybe we don't want to go through details here. We kind of want to keep the big picture. But so we can go through gas, we can go through oil. Huge problem now with Russia. That is set in stone. That's not going to change course. And we have the metal side, the nickel, the copper, the zinc, the lead. All of those are hurting. The aluminium is hurting. Aluminium used to be like what I like to say, like shopping groceries. It was available, it was there was too much of it stored, and so it was easy to buy. The price was always like just marginally above the cost curve. 1/3 of them wouldn't earn any money in the cost curve, as the commodity cost curve. So always the last guy doesn't make money. So that game completely over, right? It's not like going to shop for groceries anymore.
But it also
don't
means
forget that some of these commodities, like for instance cobalt, 80% of it comes out of DRC.
Yeah.
Now, why do I say that? DRC is not Norway when it comes to sourcing oil or gas, right? You have the rule of law. You have, you probably as good as it gets out there in a service sector or brain power or new projects or bringing it all in what we say in German Einklang, like you take care of nature, being responsible producers and so on. But the cobalt in DRC is a completely different game. And if you pay attention to what Glencore did in the last 10 years, they gave back the mines 3 times because they are so fed up with this constant local little bitty corruption. The moment you have the cobalt, they don't let you export it and this and that. So it's a very tough process.
But it also means that it's a very interesting time to have your job looking at this data all the time because the volatility and the rapid changes. But just one question, because we go so directly into the details, but just for people who don't even know how to separate a commodity from a non-commodity, can you just give the ABC lesson of what is the definition of a commodity? Because there's many things people maybe would think is a commodity that isn't recognized as a commodity, right?
Well, whatever comes out of Mother Earth, I would say, to keep it simple for your audience. And then that's obviously not quite true, because if we transform natural gas, methane into, in the Haber-Bosch principle, Karl Bosch and Fritz Haber invented this process to create ammonia, which is the ingredient for fertilizer, one of them, right? Nitrogen is made out of ammonia. So that process, there is a industrial process behind. So, but it's still then when ammonia comes out, it's considered a commodity. So it's now is oil, it's a little dangerous to define it too precisely, because the moment the real commodity guys are at the table, they say, no, but you don't understand. But, what comes out of Mother Earth, I would say, and then is there one oil? No, there are hundreds of different of oils, sour and sweet, and different classifications that matter to when you and I would work in a refinery. We would look for this type and not that type kind of oil and so on. But it's a commodity, right? And And what is, I think, important for your audience to understand is that commodities, unlike equities, they are what I call spot assets, right? They price at the margin on the basis of the physical market. So the market, let's say, today needs 100 million of oil and can only find 100 million barrels, right, of oil today, and it can only find 99. So we have to take one out of storage because we have some storage in this world. Then the price goes up slightly, right? This 1% that we don't find makes the price. And that is true for all commodities. So if we are in a deficit, prices go up, and that deficit is defined at the margin. I think that's the best I can explain it in this format, but please follow us on Twitter where we explain it in more detail at times. And then obviously an outlook matters for commodities too. So for instance, if you are in 2014, where we had too much oil and we were in a surplus outlook for oil because of what happened, what was going on in the industry that they call US shale drilling, then the price doesn't go up, because even if you have a disruption for a short moment, everyone says, don't worry about it. There is plenty to come. We are not short of it in our outlook. But if you then suddenly go into a period where there has been underinvestment, because obviously this extractive industry called commodities needs constant investment into bringing more out of it. And if you haven't invested enough, as we've done for the last 6 years, almost in anything, in some cases for 10 years, the outlook suddenly becomes of a structural deficit. And then the price behavior changes of commodities too. And then I would say the last layer that probably, in what is commodities, but also what makes the price of commodities, there are technical aspects in there, in the fiscal world, but also in the physical world, but also in the financial world, that can cause prices to move in extremes. So let's explain that quickly, because I think it's very simple for everyone to understand. So remember when we came into the summer 2020, and then we had too much oil because the world had to stay at home, couldn't use the car, had a completely different behavior for the first time ever since we know oil. Now, so here is the thing about oil. You cannot just get rid of oil when you produce it. You have to bring it into a system which is called storage. And if you run out of storage capacity, as we did, now you have a problem. Where do you put that additional barrel that you just produced? And so again, the price needs to work on that and needs to send a signal and say, stop producing, stop producing. So the price has to continue to go down to the marginal cost of each barrel produced in order to incentivize that the producer, a great family like the Lundin family that runs this, or the Rocke family, Röcke, I think you say, to tell them, hey, stop producing. We don't know where to put your barrels. And the price does that by going below the cost of production, the marginal cost of production, so not the entire Abschreibung, the depreciation of it and so on. And then people, take decisions and stop those. And that didn't happen perfectly, because it never happens perfectly, right? Because everyone thinks like, there are hundreds of thousands of producers out there. And then the Lundin family said, well, we are a $20 cost company. Why don't we let the $50 cost company shut in their wells, right? And then they wait. Rightly so. I would do the same. And then that guy somehow has to pay interest and says, no, but I can use this additional dollar that I made. It's very little, but I need it and then he doesn't shut in, right? And that's exactly what happened into the summer. And at some point, storage was full. And then there is a pricing hub, which is called, in America, they call it WTI. And we in Europe, we call it Brent. And then there are different prices of oil with different names. So on. But then over there in America, in WTI, there was a landlocked kind of pricing hub where there is storage facility, and this additional barrel came in. Call it an additional barrel. It doesn't matter amounts and details here now, but this additional barrel comes in and no one can take it. So what happens? Well, behind that barrel is a contract, right? That needs to be fulfilled, and someone had to deliver that barrel and couldn't, or someone had to kind of, where do I bring this barrel? Where do I bring it in storage? And he couldn't, because the merchants, the traders said, no, we don't have space for your barrel in our storage, and so the price collapsed below zero. And you could have helicoptered out that barrel, right? And said, no, I mean, that's silly. Let's take that barrel and bring it somewhere else. But in that one moment, that's going back to the technical aspects, that made the price of oil go below zero, despite this valuable barrel for society. And so technical aspects in a specific moment can matter. We saw that in nickel 2 weeks ago too. And without going into too much detail, but in general, commodities price of demand and supply. But they also price of the outlook of those commodities. Is there a structural oversupply or undersupply in the world to come? And then there are the third element is call it a technical element, which can cause a lot of price volatility. And I think that's what you're going to see in the months ahead, where we might have the reverse of what we just had in June 2020, where suddenly someone needs the barrel but cannot find it, and then prices overshoot and have nothing to do with the production cost curve of that commodity, but just it overshoots because there is a contract obligation and it cannot be fulfilled, and someone needs to close a position and cannot close it out. And then there is what I would call technically irrational behavior. But I expect more of that to come as we are in short everything. I mean, it's for me, it's at the moment hard to think of a commodity that we have too much of. I don't know. But even there, I will have to dig in deeper to be absolutely sure. But it's all linked, and we are short of it, and we underinvested as a society for 6-10 years, and here we are.
Do you have any favorite commodities, or is it just as easy as you spend the most of your time on oil and gas because it's so big? Or do you have like small commodities you just love to follow and track? Or is it just like, I want to see everything all the time? Or do you have to focus on one commodity at a time? And how does the commodities interplay? Is there a great correlation all the time? Or is it like a pattern, a symmetry, or can it be all over the place at all costs?
No, they all have their life. It's like, first of all, I would say I love all my children the same. And then second, I would say, of course, oil and gas, such a massive sector, much larger than all the others combined, obviously gives you more investment capital allocation opportunity. And that's why we spend the most time there. We are stock pickers and hopefully long-term investors. And on that basis, it's a fantastic sector, because with the same knowledge, you can look at 1,500 companies and you can fall in love with some and not with others. You have great management teams, great reservoirs out there that are misunderstood or not yet discovered by the market, and that's what we go for. So, but I would say they all have their own life, but funny enough, they all have been similarly badly treated for the last 10 years. I would say the last 10 years has seen the greatest shift ever from what I would call the real world into, the metaverse kind of world. The tech world. That shift has hurt every single commodity without doubt. And we have to be honest too. I mean, on average, many capital investments in commodities are misrepresented and turn out to be too optimistic and turn out to be bad capital allocation. This was true for the entire US shale patch in the United States for, between 2010 and 2020. They've lost an enormous amount of shareholder value through good money after bad for literally 11 years. And so people were fed up to even look at it. But so here we are.
Given that you invest in commodities and try to find great companies, can we just go one sector abroad? And if you look at it as an investor, could you also just be an asset allocation play on the different commodities that now we're bullish on oil and we're short on nickels, etc.? What's the difference between, having an asset allocation mindset versus a stock picking mindset? Because you could maybe do both, but it has different trade-offs, right?
Yeah, you should do both, right? You should not just. What we do is, look. I started my career firstly a little bit in investment banking, and then went operational, and then went back into private equity and public equity capital allocation. And so a total of 25 years and about at least 12 in capital allocation. And why do I say that? Because in private equity, you come from a very strong, let's look at the micro perspective. And you focus on this and what can we improve and how can we make this flower beautiful? And that is pretty much what I learned a lot, and I like that too. As you know, in Petrotal, we are in that situation now where I totally love our position, but I see opportunity for improvement. Okay. Now, that's not enough. So I took a sector, then obviously we understand, let's stick with oil for a moment, but we can absolutely talk about all sorts of others. And in fact, I'd love to talk about others too. In 2017, we started to look at we always look at the sector of oil, but we started to see issues coming in the oil sector already. In 2018, we were convinced we have a supply issue to come here. And for many reasons, we published it. People want to go on Seeking Alpha. That's where we published a paper, and it was widely discussed and so on. Even came in the Financial Times. Okay, because at that time everyone was still very bearish oil, and then it turned out we were a little early, not the least because of this COVID. Fair enough. I mean, COVID changed the demand side. It was a demand shock that we have never seen, nothing close to it. In 2008, we lost something like 1 million barrels. The deepest recession the world has ever seen, the great financial crisis. And in COVID, we lost something like, no one knows exactly, but about 22 million barrels from being restricted to move. So it was just a massive shock to the system, and therefore caused a lot of damage to the sector one more time. But anyway, already back in 2018, we were rather bullish and were actually positioned that way. And then came 2018 Q4. Trump did a little trick there, in the geopolitics of oil, in the discussion with Iran, and gave them said to the Saudis, by the way, we need more oil, pump. You remember oil prices went up back then. Then he gave the waiver to Iran, so therefore the Iran oil was also suddenly available. So suddenly the physical market wasn't so tight. And then Powell also increased interest rates, to which I thought, so what, 25 basis points, but in this financial system that is highly leveraged, it matters. And then we had this massive collapse of oil from 94 something to 50. Now positions, we had a fantastic year so far, then suddenly got hammered in November and certainly so in December. And I was like, wow, what am I doing here? You know, with my private equity stock picking thinking, you know, I need to improve my game, right? I have a blind eye. And so we invested a lot of time into macro. And rightly so, and not ourselves so much, but finding the right partners for us to advise us on macro and on a daily basis. And that's what I do today. And so I'm extremely macro aware because I think it's important. At the same time, you need to be sector aware. You really need to understand the fundamentals of the sector, and then you need to be company aware. And that combination, I think, makes for good allocation for over a period of time. And you can also risk manage those positions then better than when you are macro unaware, because the cycles or the mini cycle, the within cycles of a cycle can be so enormous that you want to manage that risk a bit.
But also, just to add on that argument, you have quoted Charlie Munger in your investment letter in terms of, you know, always the discussion about diversification versus just being passive, right? So do you just want to say why you quoted him and why you do that in terms of your investment letter?
Yeah, look, there are many styles out there. And at the end of the day, I mean, I think if you charge a fee, you have to, I think you can only justify it if you add alpha. And if you cannot add alpha over time, you know, not one specific year, 2 specific years, but let's say 6, 7, 8 years, you have to provide it. Doesn't matter your style. And meaning alpha, the difference between investing in an index like the S&P or the Norwegian or the Swiss SMI or something like that, and then your own selection of choosing. And what I think the main reason is why this is hard for most out there that are professionally in this business is, in my view, because they are diversified. When you own 25 stocks, I think it's hard to find 25 ideas, believe it or not, that are outstanding, massively better than, you know, that are the next Google or the next this or next that. And that's just very hard. But because the market is inefficient, but it's not that inefficient either. And the market is also narrative driven, moody, can change its mind very quickly. So I think you need an edge in terms of, you know, what you really know, that what Charlie calls the circle of competence or the Buffett. And I think we have that, right? We define those resource investing, our circle of competence, not just, but mostly. And then you have to see something others don't see, and then you're going to go in there, and then hopefully over 5 years, like in Petrotal, people start to realize, wow, that reservoir is completely misunderstood. This is not a 50 million reservoir, this is a 100 million barrel reservoir. And that changes everything, and that's where your alpha comes from over 5 years. And at the same time, however, you have to, you don't want to lose your clients in times of volatility when COVID hits. And that's, you know, the other side of the business that you somehow have to manage too. You kind of have to keep them entertained because you know, we just don't know what the share price is going to do tomorrow or thereafter. I mean, I just don't, right? If, you know, don't underestimate, you can be in exactly the right idea. Like there was an English company called IOG, we were large in, but there was one shareholder that was kind of became a forced seller, and then, you know, that shareholder has to sell and sell and sell, so that stock price is not going to go up. And these are important parts, of course, of your analysis. But what I'm saying is you don't always understand the timing of when such a, you know, what I call a share overhang is in place or not. So there are many elements you need to coach, and you need to keep at the same time your clients entertained. And, you know, believe me when I say, because I had a couple, you know, their clients often, you know, they seem to be completely in agreement with what you are going to do until you get to the moment of volatility when they may be not in agreement anymore. And so don't underestimate. If you can handle volatility, that doesn't mean your client can. Although they may say so, but I think that's why it's so important. Also, by the way, Charlie and Buffett say it all the time, right? You need to find a partnership with clients. If you just have clients that they expect you to perform and you expect them to pay your bills, that's not going to work out for the long term. I think that's going to be that's going to be a girlfriend, not a marriage. And I think you somehow have to find clients on the other side that really deeply understand what you do and why, and then kind of you explain them truthfully, right? Like very like Swiss, Norwegian, like no bullshit kind of, this is what we do. And then they buy into that, and then hopefully go on a journey together for the long term, and you're successful. But if if you have to manage every corner, every quarter, like most guys on Wall Street, I think that this job is a nightmare.
It's super interesting because I think you wrote it as well. Like when you find a case, you actually have like 10-year horizon on that case. But in that 10-year period,
Red Bull should pay me, by the way. This is Red Bull.
They're also doing quite well. But given that, time is the biggest advantage to any investor, straight to your point, it makes it so hard if you just like going to allocate capital on behalf of clients you don't really know, right? And you don't determine the market day up and day down, right? So it seems like...
Yeah, exactly. I think you need a close relationship with your clients, or you're not going to have happy clients. I have a lot of clients that used to work with me in Babcock and Brown, in the private equity company, in the software world that I used to run operationally and so on, in all sorts of kind of people that you picked up in the journey of your life, where we have a deep understanding of each other and we trust each other, and they know that I'm hardworking and that I'm serious and I really look at these things in serious. Those relationships work fantastic, right? Even if we have those high volatility, which we had in 2000, right, at 2020. I just told them, don't look at it. Don't. We didn't buy rubbish. We have a fantastic reservoir. What I'd like to say to them, really like Mongo, right? We buy companies, not stocks. If you're in the stock buying business, I find it very hard. If you're in the company buying business, few things that you really understand and not pretend to understand, industrially kind of understand, and on top have a bit of a risk management layer, I think you're going to be fine. It's not for everyone, because there are many styles, many ways to roll. And I don't think mine is made for others, right? That's me. I think everyone has to find out who they are and what they can do best. There are incredibly talented people out there also on Twitter, high frequency traders, or, these quant guys, and they just don't like, they say, what they say on Twitter? They say, oh, let's not have risk over the weekend. Now I'm thinking, what are they talking about? Right? But that's how they are. They like to have, a daily thing. For me, that would be a nightmare, because when do I read? When do I think? When do I study if I have to manage everything daily?
Definitely. So how do you like to structure a day? Because when you have all the commodities to look at and you're trying to find very good cases, do you have a clear structure, or do you feel like it's a bit serendipity, luck? You read something, you dive into it, or do you have like a structure from A?
No. Yeah. Don't. Look, maybe that works too. This scuttlebutt thing that is talked about in books by Peter Lynch and so on. But look, I have a rather structured approach. So first of all, I think you need routine. Look, I used to play a lot of, I used to do all sorts of sports, and in some of them I really wanted to be very good. right? And then I learned a lot about our brains and so on. And for instance, in golf, you don't get anywhere if you don't have routine in front of that shot. And that's a process that needs to be very clear in your brain in order to become a single handicap or scratch player. You never become that kind of player without a clear routine that you need. And I think in investing, it's the same. And there are many ways, I think, there to go to. My routine is, for instance, I have dogs and I go and walk with those dogs for an hour, that no one can take that away from me. Between 11 and 12 sounds incredible boring life. I love it, right? Because we Swiss have this privilege, this enormous privilege of, you live in Zurich, you go in the car, 2 minutes later, you are in the most beautiful forest, right? In London, it takes you, 3 hours to get there. And then you walk with your dogs, you come back, and that's my way of having my brain consolidated, my thoughts, my anxieties, my anything, right? My creativity comes out. So that's one. I think you need routine. I think you need to wake up at a certain point and go to sleep to a certain point in a routine-ish way in order to maximize your output. I think you need to come into this game with the right tool set. I mean, if you're slow if you don't know how to do certain things that you need to do, I mean, you cannot go to a ski race and you need to figure out how to put your skis on, right? It just doesn't work. So that thing you obviously need to bring to the game. But then I think what I try and do is to have the least amount of meetings, I literally try to avoid them at all. I don't like to go to conference. What I like to do is just to read and think and go about these things of these companies that we know well on a daily basis. And then if there is something that catches my eyes, then I like to call them the company and ask them about it. Give you an example. I don't like to be pitched by someone. Have you heard of Serica Energy? Maybe that's a good thing and so on. And then they sell it to me and then I don't go about this freely anymore, right? So rather my approach then is, okay, I know Serica for a long time. We've been in there twice and we re-entered the position, this UK gas player. And then there is this angle about, a development that they do that looks very interesting. And then I read and talk to some, we have a loose network of specialists. Like I talk to a friend of mine, geologist, and say, what do you think? And we go about this data and then I co-manage. And then usually I have someone with me on the call that knows a lot more about these things than I do. I'm not a geologist. And then we ask 2 or 3 or 4 questions in the most neutral possible way so that I get a feeling what it really can be. And then we take some assumptions on it and that's how we go about it. If you talk too much to managers, the good ones, they really know how to sell their company, right? And then you think in the States you find a guy that tells you his reservoir is very bad, by the way. Oh, please, Alexander, we'd like you to know this reservoir just makes it right, but nevertheless, the stock's going to go. No.
It's super.
So you have to have an ability to find these things out for yourself and to create a network. By the way, I don't think for that you need to have hundreds of employees. You need to have a network and access to people that like to help you. And then, we pay also a lot of fees to external advice where we think, now this is important. We need to understand that in detail and have an expert on this specific question, and then we feel comfortable.
But isn't it that like the funniest part of being an investor, because you have to have everything at play at the same time? You need to be stubborn on something, but also very flexible and adaptable. And there's a big herd mentality, and you don't know if the herd is right or is it wrong. So you have to sort of be extremely good at separating noise from signal, right? And maybe that's the hardest part. And maybe you can't get that level until you have had enough experiences, because it's easy to say that you're not going to be convinced by good management, but maybe you're not conscious about that for the first 10 years in your career. maybe you are, because everybody can be sold to.
Yeah,
It's easy to say that no one can sell me something, but we all get sold to all day, right? All day long.
And victims of it too. Now, no, you bring up very, very powerful points. So first of all, I think the experience curve is something you need. I think if you're, Buffett started himself when he was extremely young. He quotes something like 14 when he did his first investment. So, but Buffett is Buffett, right? He has an amazing brain and an amazing emotional game he brings to this. But I don't think many of us are like him. But I think what you are saying here is I would like to take that to the emotional world of this job. And I think there you need to really have, you need to come to this game, whatever that age is, when you have a good understanding about yourself. Because I think that it's where when the emotions kick in, when things go up and you become too excited, or when things go down, you become too depressed and so on. That shows me you cannot handle the emotional side of the business. Or you probably haven't done your homework at all, or very little, right? And then the price influences you so much that you assume the price is always right, and therefore you are wrong, right? And then you shouldn't be in that business at all, right? If you don't make the price your opportunity, but your problem, you should not invest in publicly listed stuff. But that could make you a super investor in the private sector, right? Where you don't have these constant quotes every single day. But the emotional side, I think you have to understand who you are, what makes you tick on the emotional side. Read these Daniel Kahneman, Thinking Fast and Slow, these kind of things. Dale Carnegie, the psychological side of the business, and then find out whether you are that person. And I think some people are just born with that; they are made for that, and others are not.
But that's super interesting because, are you on that side that you think you have to be sort of born with this to handle this up and down? Because if you lose clients' money, right, like at least in my experience, like losing my own money doesn't hurt at all. If I believed in an idea.
I'm like you. I find it much easier if I'm positioned and I have volatility. I really don't mind it, but I mind it for my clients. It hurts, but I had to learn that. You have to kind of go through that. You have to go through it, and some clients gonna be angry with you too. Although you've done a fantastic job, but you are just positioned in a way that doesn't show the rewards yet. And you're right, and it takes more time, and you go through that process, and it's painful. I find nothing funny about it, but it comes with the territory. Or the alternative is, which how I started on the public side, is try to have enough money so you can do it for yourself. You live a humble life, and then you compound what you have, and you don't have clients, which I think is a very powerful setup. To be in the client business is don't underestimate. To build a business where you have clients is also not the same as to allocate capital, right? You have to distinguish. There is a job of a good CIO that understands, that sees the research, that knows how to allocate, that does the portfolio side, which is, by the way, some argue also a different job, portfolio management versus research. But let's assume that's the same. So you combine that, but then there is the client side, the selling side, the schmoozing side, the entertaining side. And then there is, if you want, the CEO side, where you have to make this a business, you have employees, and everything needs to come together.
But isn't that the perfect example? Because if you take Warren Buffett and Charlie Munger on one side, and then you pair them up with, the guys who have built Blackstone and BlackRock, even though there are investors at heart, it's a very different journey. It's like two different sports.
That's like mini golf and I don't know, scuba diving. It's just totally different. The BlackRock guy, I mean, incredible what this Larry Fink has done, but that has nothing to do with what Buffett has done. they I don't know how many trillions they run now, but I have no idea how he created that. And I don't know, I have never met him, of course, and I cannot comment about it, but it's incredible. But I'm absolutely sure what he has done has nothing to do with what Buffett has done.
Yeah, because just to add one concept, so I'm a person who really hate internal politics. So internal politics happens as soon as you get 5 to 10 people on board. And if you get 1,000 people on board, it's like maybe half of your day is spent on internal politics, right? So just imagine building those companies like Blackstone and BlackRock, how much of that percentage has been internal politics, hiring, firing, buying up companies, selling companies. While on the other side, you can actually maybe be an investor for, let's say, 50% of your time. And then the other 50% is clients, that stuff, right? But it's just so.
And those are important questions, and you wanna position yourself there where you feel most comfortable. And I would argue, I have very little desire to grow my shop, from outside, because I just, I love clients. I love to have good relationship with clients, but I like harmony, and I like an understanding and respect of each other. And if I realize that, I had clients before where I simply said, look, we are not made for each other. And there was no damage. Just one client once called me and said, by the way, for me personally, the performance is 14% or 12%, and for that specific year, and for the company side of the business, it's 16%. And then he wanted to go into all sorts of arguments about it. And I explained to him, I said, yeah, but you told me, to be careful here or this or that. So I kind of tailor-made the portfolio a bit for him, and then he underperformed a bit the company side, and I just realized in that discussion there was the wrong arguments coming out. There was like the coolie politics, and then you're not made for each other. And so for me, it's very important to have a loyal base, and that I prefer it small than big, and having all these, the bigger you are, the more different the clients will be, and the more institutional the setup has to become, and the more rules they're going to apply to you. Also, this entire, if you have a fund, we have managed accounts for our clients. Right? If you have a fund, and that's under Luxembourg law, then there is a diversification rule that applies. And that's exactly, I think, one of the problems why it's so hard to perform. So I try to avoid that.
Definitely. But I think these examples are great for people to think about, because it goes back to your point, is that you have to know yourself. What situation do you like to be in? And what situation do you hate to be in? So if you know that from yourself, like the best part would be to experience those situations. So maybe try, if you work for some companies, you will actually get a feeling of that. But before you decide your investor career, if you answer the question, what do I want? And when do I think I perform? It's much easier to pick the right route, right?
Yeah. And I think for many of us, the truth is we have to, life is not a straight line, and you're not going to figure it out at first. And so maybe you have to go and walk a little bit in the wrong direction first to then adjust. But I think you should have the courage to adjust when you see, like, this is not me. And I'm not sure, I wouldn't advise anyone, go for your passion. I think passion is more than the outcome there than it is the input factor, right? I think you just have to do what you think you're good in, well, you, of course, like it somehow, it should be a bit of tap dancing to work the Buffett book, right? Rather than finding it not interesting. But the more the better you become. I think the output is passion, right? And you start to like it a lot, and certainly you need to like it enough, let's say, to go through those patches of difficulties.
It's so true, and I also think
that you don't throw the towel on the first Kieselstein, we say in German, the first granular little thing on your way. This is too complicated. That's also not going to take you there.
But I also think if you're just gonna discuss the word passion, I think way too many people start off with what am I passionate about? But I think that's like a blind alley to start. Like you should start with what gives value to other people and track your way back and see if one of your passions aligned with giving value. Because you can be passionate about a lot of projects that there's not a lot of willingness to pay for. And then you run into a big problem because your passion doesn't get you paid. And then you don't have to, and then you get a terrible life because you get stress and you don't have money for your life, right? So it all adds up. But I think maybe just start with the simple question, what gives value to people? And then you can work your way backwards.
Yeah, although, of course, but I think you'll find that this is often not so easy to answer. I mean, if you and I say, okay, let's do something together and, even start a small community on Twitter, it's not so easy to know what makes people tick. And suddenly, you think you do something or say so or help someone that is amazing. No one cares, right? And then you say something which is like, of course, right? Ammonia has to do with food. And then that goes completely viral. And you think like, what were you thinking? Yes, high natural gas prices is indeed the problem for food. Yes. Oh, you didn't know that? Okay, so here is the 20,000 retweets, right? Suddenly in one day, you go like.
Yeah, but the world is very unpredictable. So sometimes you don't know, but then you have to at least experiment, like you're saying now with the Twitter cases. So then it's all about doing the Jeff Bezos argument of, okay, let's run 10 experiments. And if 2 experiments goes very well, maybe there is a product here somewhere.
Yeah. The software guys these days, I think they are very, let's go out, let's try, let's see what works, and then improve or close it down again, and so on. So, but that's obviously a little hard. You cannot just, okay, let me try to do a hedge fund. It didn't work 3 weeks later. No, so, that's a very good
point.
I mean, it's not. Look, I think. I didn't think of becoming, exposed to public equities and call it for simplicity reason. I'm a hedge fund manager. I didn't see myself doing that when I was 25. I think the journey it cannot always be understood exactly, and at some point, you can also be in something which is actually very interesting, and then you should probably stick there, although it doesn't make you like, it gives you that factor of making a lot more money, right? I think people are often also, if you're just trying to make the most money, then I think this industry is not the right industry, because I think it's much harder to make money here than people understand.
Yeah, I definitely agree.
So let me explain from a psychological side. Like, so what we do is we really understand the company, we invest in it, and then, we are exposed. And then that share price goes against you because, I don't know, Jerome Powell raises interest rates 75 basis points instead of 25, which everyone expects. Okay, so the stock goes down. So now do you feel miserable because you just lost in the book money? If money matters too much to you, I would almost argue you're probably not going to become a good capital allocator.
It's a very interesting perspective, and I think I agree so much, because like if you take the public markets, like I don't know if there's research who can say this 100%, but how much do you really know what drives the price? Because there has to be so many factors that it's impossible for you to know exactly what goes around.
Look, we're long enough now in this business to make comments about that, and in most cases, I didn't know what moved the price. I give you an example. We were big in Songa Offshore. Do you remember that company, which was taken out by was I going to send you our investment paper for your own amusement? But we took a long time to analyze it and so on, and then we went in and it moved down immediately 20% on us on some technical reason. And then within a week or so, they corrected again, and I never really knew why. Then I called the broker and said, why this? Yeah, but you know, it's really hard, even if you do this day in, day out. And clients sometimes even call me, which they shouldn't, right? And say, why has it moved now? And I think look at those price movements once a day or maybe twice a day max, but maybe once a week. But the reason we look at it is simply to say, should we buy more when we like something very much? And with PetroTal, we had this, local protest, which means very little for NAV, right? If you NAV something, if you really do the model, I mean, a 20-day protest has just no impact on your NAV over 10 years, just none. And so then suddenly the price overreacted and went from 30 to 16 in a week, and my God, what's going on here? And then we took opportunity of that and we bought more and more and more, because I thought has to be that kind of news about the protest, right? And then you go for it. But I look to understand why prices move and to kind of become a day trader. I think that's some people do it, and I'm sure there are successful people doing it out there. I haven't met them personally, but I'm sure some know what they are doing. But I think that's, if I shouldn't say it wouldn't be for me. I mean, it would make my life miserable.
I mean, that's obviously there are people great at anything in life. Like, if someone can trade on like high frequency, like, of course there are sure people, but then it also comes to a matter of like, okay, let's look at the time frame. What's the scenario? Can we simulate this in other worlds? So it just goes back and forth, right? So instead of like wasting time on saying a day trader should exist or not, right? Maybe you should just try to find your edge and then excel at your edge.
Exactly. That I couldn't agree more. And I mean, I would argue a high frequency trader is actually like a kind of a software engineer. He couldn't care less about the company, that I guarantee. Right. And so if you are that and you know how it works, I wouldn't moralize these things either. Are they good or bad for capital markets? I think whatever provides liquidity, I would argue, is good for markets. At the moment in commodities, you see that we don't have enough liquidity, we don't have enough participation, and that's why prices move so extremely. And so, sure, no, you have to know who you are and then try and approach it from that angle.
But looking at commodities, because let's just give the listeners and audience like a sneak peek into your brain looking at commodities, because I took down the 2021 returns in commodities, and there's like this enormous spread, right? You have coal and crude oil like definitely on top with high returns, and then you have silver on the bottom, etc. How do you like in today? Of course, you can change your opinion tomorrow. Let's be aware of that. This is not like how do you say, like the correct answer at every situation, but what are you looking at now that makes you really intrigued for 2022? Do you have like top 5 picks at all, or is it too hard to call that in the yearly basis?
No, it's not too hard to call. No, we can go through that. Oil remains a top pick because we have let me start differently. What happened in the last 4 weeks, changes the commodity landscape in a big way. And that's the war. Russia invaded Ukraine, and the West sanctioned Russia for it in the most severe possible way. And that will be becoming more, not less, in my view, in the very short term. So there will be more sanction packages to come. Now, Iran was similarly sanctioned, swift sanction and other measures. And it lost 30% of GDP overnight. And I think for Russia, this will be a big deal along those lines. Now, why do I mention that in regards to commodities? Because Russia is a commodity powerhouse. And So Russia provides, produces 10 million of the 100 million oil per day, or I should say liquids. But Russia produces 10 million crude oil and some condensate per day, and exports about 7.5 of those. Not in the form of crude, 5 in the form of crude, but 2.5 in the form of products or diesel, for instance, coming to Europe, right? And that's 7.5% of this market. And I told you before earlier that commodities are pricing at the margin. The last molecule that we have or don't have makes the price. And here we therefore have a massive dislocation in how commodities work. And on that basis, you can be absolutely sure that commodities, oil needs first of all, not a peace agreement, it needs a sanction lift. Okay? And those are two very different things. So don't expect in a peace agreement, which I hope in a couple of weeks, I don't know, at some point we'll have a peace agreement. It's not going to change anything for oil. Because although these, crude oil and gas is technically carved out of the sanction list, people are self-sanctioning, and in terms of how commodities are handled on a daily basis, it nevertheless has a huge impact. So letter of credits, which is a form of financing that you need to ship a barrel from A to B, at the moment they don't clear. Right, so if you want to bring in a barrel of Russian crude, the bank and both counterparties need a letter of credit. The banks won't clear those letter of credits. Those barrels cannot unload, so you don't touch them. So the reality and that's just one little aspect I mentioned. So there is a lot that doesn't work at the moment. Whether the sanction language says you can import or crude is excluded or not excluded. So, and that's a big deal. And so we go on. And then Russia is, 20% of nickel, of world nickel production. So it's a big deal there too. Now, the transportation system for nickel is different than is obviously for crude or gas. And we shall come to gas in a moment. But nevertheless, we'll see whether that nickel easily finds its way to China. It will, but there will be disruption. There is a period now where the value chains, the transportation side of a commodity business needs to readjust. And that's not a thing of a day or two. These things take months. And then we go to copper. Russia is about 4.5% of production, more of reserves. So it matters there too. Again, if it would be 1% in each, it would be a big deal. So we go to gas. It's a third of the European market. So the European market, which the Norwegians, I'm sure that you know these numbers inside out, but the European market is called a 500 BCM, billion cubic meter market. And Russia is 150 BCM of that per annum. Either way, without Norway, we would be completely lost. So that let's have that very clear, Sanke. I mean, Norway is the lifeline of Europe at the moment. The 150 BCM will be very hard to replace, but that's the process we're in now. Those molecules flow through the pipes that are still on. There were 3 pipe systems and the 4th one that wanted to be added. So there was the Nord Stream, so German, English word combined, Nord Stream pipeline that transported into Germany from Russia. And then there is a pipe going, the Yamal pipe, and those are the big ones I'm saying now. There are smaller ones that go the Yamal, and then there is they call it the Welke, line that goes into Austria, so to speak. And these through main systems, pipeline systems, they still work. And they still deliver gas. But why is then the gas market so nervous? Because we don't know, at any point in time, they could decide, hey, tomorrow you need to pay in ruble, which he announced 2 days ago. Or, hey, by the way, tomorrow we don't want it in ruble, you can also pay in gold. Well, 150 BCM, at the moment, the price of gas in Europe is 110 euro per megawatt hour. So 150 BCM is about 1.5 billion megawatt hours. So that you multiply, that equals about $170 billion per year. How do you gonna pay that in gold? I don't know exactly the gold reserve numbers now, but it's not gonna be so easy. And that every year, right? And then you have to transport it, right? You're not gonna do click, you have to have kind of a railway shipping 170 billion gold, but euro, that's dollars, and then you convert it into gold barrels and so on. So we could do that calculation quicker. But you see, it's all getting rather totally absurdly complicated, impossible. So but Putin made the decision. I always tweet what European politicians, the Scholz, Mr. Scholz, the Bundeskanzler of Germany, obviously he's very concerned. The Italian Mario Draghi, of course, also. But my point is, you should be concerned because you actually have to get on with it, because you don't know when the other side actually makes you force to abandon the Russian oil, because they request you to either pay it in a way that you cannot, or he simply goes so ideological, here I have to bring back the Soviet Union idea and so on, and so he turns off the gas as well. He hurts himself a lot, obviously, but he thinks he can do it. He obviously thought he can go into Ukraine and do that, and it turns out that's not so easy. So expect it. So we in my view, that's why the market is pricing gas so nervously, right? 110 euro per megawatt hour. That translates for your audience. I think everyone understands barrels a little bit better, but that translates into what? $220 per barrel.
But given this,
barrel of oil equivalent, right?
But just given the situation where you sort of, I don't know, is this information, do you feel like from an investor standpoint, it's already priced in the commodities and then you have to take a risk adjusted bet? Or is this do you feel it's not priced in at all and there's huge asymmetry coming up now?
There's huge asymmetry coming up. So I urge people to really don't anchor on what has happened between 2010 and 2021. Try to look at commodities as if that didn't exist. So you get rid of the anchoring effect that is well described in psychology, because it doesn't help you, it doesn't give you any useful information about what is going on right now. You really have to be radical in your thinking, or you're going to be completely on the wrong side of history. Now, is the price of gas rational at the moment and has anything to do with the cost curve? No. But why is it the price? Because number one, if Vitol, which sits here in Geneva and manages about 10% of the oil market, call it the oil and gas market, or Trafigura, which sits here in Switzerland and manages about 6% or 5% of the oil and gas market and the metals market and so on, or Glencore, which sits here in Zug and so on. These big trading houses, Mercuria, they at the moment need to deliver if they want to transport the gas molecule that is priced. The other day when they were sitting here in Geneva at the FT conference, they were saying, okay, on a 94, I quote, now I don't make it up, I quote him, you can look it up on my Twitter account, you'll find the quote, him explaining it, the Vitol guy. On a 94 euro price, he needs to bring 80 euro margin. What does that mean for your audience? That means if you have a loading of, say, 100 million worth of oil that they need to deliver, that they need to ship, it means in the past they may needed 10 million, 5 million capital on their balance sheet. Now they need 80 million capital on the balance sheet. So a bit like in the financial crisis, the business has kind of changed overnight, and it's a lot more capital intensive, to the point where these big trading houses were probably at the brink of bankruptcy. Now, that's a careful thing to say here for your audience, but I think it's not that off. It was maybe a de facto kind of liquidity crisis for them, which they obviously very, very well managed, and they knew how to address it, but it means their business shrinks. The capital requirement went up. It's exactly as when we go through the financial crisis for banks, where they needed like 5 or 7.5% capital quota tier 1, and now they need 15. So it changes your business. You lend less. When you come and say, okay, they say, no, but and we need this, and we need more, mortgage, no, not 70%, only 50%. Right? And so on the house price. And that's exactly what's going on in commodity right now. So they all need more capital to just do the same as they did 3 weeks ago. The market is in an emergency room. And I think your audience should know that. And that emergency room is not going to go away until sanctions go away. So now for your audience, when do sanctions go away? In my view, that's a view I personally have. But so far, I said he will invade Russia, and he did. And many people said, no, you have no. So maybe our way of thinking and looking at things is maybe a little bit more creative than most. So my point is, sanctions, in my view, cannot go away quickly. Why do I say that? Because Mr. Putin broke an unwritten law of international relations. And that is that you cannot threat with nuclear, call it a nuclear attack, even though you have that power, you just do not threat with it. Even in the times of Khrushchev, the Kennedy crisis in the 60s, they actually didn't threaten each other with a nuclear attack. They were a crisis, and he said, JFK demanded Khrushchev to remove those weapons from Cuba, which then became the Cuba crisis. But it wasn't a threat, a direct of, I may do it. Now, if you go today on Russian TV, I don't understand Russian, but we have a lot of translation these days in all sorts of, they literally say it on TV in their propaganda day in, day out. Putin goes out and says on the mic, by the way, I'm happy, if you do this or that, I'm going to throw a nuke on you. So this, whether he does or not is not my topic here. I don't want to also cause the wrong discussion here or fears. I think that's what he says and what he does, two different things, although he did a lot of what he said. But let us not go in that rabbit hole. What I'm trying to say is he threatened the United States, the UK, France, call it the three big when it comes to nuclear in the West, with a nuclear attack. He even threatens Poland, but they don't have nuclear weapons. I think he threatens all of us, and so you cannot go back to business. I think what we need from here is we need a post-Putin time for sanctions to lift. I'm not sure that's going to be soon, because somehow he can keep it together in his corrupt system over there. And then two, we need checks and balances, or alternatively, kind of a de-armament of nuclear warheads, of 7,500 nuclear warheads there. I think that what I just said is going to be a non-starter, right? It's a very proud, history-rich, incredible nation, Russia. So I don't think they would allow a de-armament. But at the same time, the West will say, well, if you don't want that, how can we make sure that not the next dictator comes and threatens us again? And maybe we go in an accident. So I think we are this is the overarching dilemma that we are in. And I don't see a solution anytime soon. And I think that's going to drive, commodities came into this overarching problem already with underinvestment, undersupply, under this. Every single one of them has its own problem. And then on the demand side, we have the net zero topic where we try to have much more metals and so on. So the demand side is actually, for many commodities, is going to explode. The supply side doesn't work. And now on top, we created this kind of overarching dilemma where we cannot sanction lift, in my view. I mean, maybe a politician kind of finds a way out and says, let's let the world go back to, but I think in the past that hasn't worked. The appeasement policy hasn't worked as with Hitler. So I don't think the politicians now are, and let me put it this way, I think the motivation is now here not to appease anymore, but to resist. On a European level and hopefully in the US context. And if that is true, what I'm saying, then that's the context of the commodities we are in, and that means it has all sorts of consequences for all sorts of them, and you have to go through each to understand. But this is why I think when I tweet in this decade, unless you understand commodities well enough, I think you will have a very hard time to navigate capital allocation. This is the context of it. And again, we can go again deeper and deeper on all of them, but I think for your audience, this is what one needs to understand. I don't think gas prices can relax much, because with this uncertainty that we have, it means that the price of European gas, let's go back to gas, which is important to your Norwegian audience, I think, has to stay high in order to incentivize the marginal LNG barrel, liquefied natural gas, that stuff that comes from far away, that is like kind of ship that transports it, it's like a pipe, you have to think. It brings it in from the US, right, which has it, which is a net export of gas. Then brings it in from Qatar, which is a net export, and brings it in from Australia, which is an export. These are the big three, and then we have some from Africa, Nigeria, and so on. Doesn't matter, but those compete to also bring it to Asia, which is call it a 600 BCM, 650 BCM market, and that wants, by the way, to become a, bigger market than the US, which is a 1,000 BCM per annum market, again, billion cubic meter per year. So the Asians want to replace coal with gas, so they grow the gas. So and they are also net exporter. They don't produce it, like Norway, too much of it, but too little of it. So they all compete for the gas. So what needs to happen in the price finding? The European price needs to be above the Asian price, significantly so, to justify the rerouting, and for a decision making from, say, Australia. Okay, most of it comes from the US at the moment, which is a cheaper route. But in the future, if we need to replace 150 BCM of Russian gas, that's so much that we need to replace. A third at the moment, only 11 or 12% is LNG of that 500 BCM market. So we need to become so much bigger. So we need to keep that arb open, number one. Number two, we need to create additional terms. Number three, we need to probably curtail our consumption pattern. Because the last part is obviously where we kind of supply and demand can meet again. Assuming that Russian gas, although flowing today, is a massive uncertainty in the future. And that's why I argue and I promote and I try to help people to at least make some money in the market when they have to pay all these extra bills on top, to look at a company like Serica Energy, which is a UK gas player, which is a one-on-one beneficiary of that situation. I think that shoulder season, meaning, in the summer, the gas price is usually low because we don't consume it. We now fill up our storages for the winter season. But I think that shoulder season is not going to be looking anything like the last 10 years. How should it? On that, a supply and demand situation, and you add the geopolitical backdrop on it, and you add, the technical aspects of the physical market, of the traffic Uros and Vitals. put it all together, and I think people are still in a group think. I'm shocked when I read these experts, thinking about these things day in, day out, and then they have the price tag, and I look at it and think, so how is that gonna bring us the gas into Europe? I think people really have to be a bit, go the extra mile here and start to think about these things in a clear, what I call clear thoughts. And that's the backdrop we're in, and that backdrop is not going to change. How can you change? And then there is always this, 10% that, we like to think in probabilities too. Sorry. Pixie, wir sind am Interview.
It's perfect. For those guys listening, we have a new guest joining the show, but I guess he or she is ready for the 1 hour trip soon.
I picked her up on the street, and she's fat. I think her brain is bigger than mine, and she understands everything. I just asked her to wait a little bit. No, but the point is,
isn't this just
we think storm, sorry, right? When I finish that, we think in probabilities. Now, but I don't want to scare you all and say like he's a fanatic. No, we think in probability trees, all right? And we always have scenarios. But at the moment, you bet that we have a very high probability rating for what I just explained. And of course, I pay attention to other outcomes. And I think a peace agreement will take our gas price down immediately for a moment, but only to go back up, as you saw it in the last 3 months, right? It's this roller coaster where it goes up, but on a very high level, right? Of course, gas prices come down on a peace agreement, everyone says, oh, now we're back to normal, only to find out 3 weeks later, nothing has changed.
But isn't it also, just to keep it simple for people, that extreme action also often lead to extreme outcomes? So you had COVID, that's an extreme case, right? Everyone is locked at home, extreme, volatility. And also a war in Europe is also a very extreme case. So you should expect extreme outcomes, long-term consequences, right?
I would agree with that statement, and I would argue that Europe, although they cannot admit it publicly, the politicians, when I say Europe, I mean von der Leyen or Schulz or Macron and so on. I mean, how can they not work on complete energy independence from Russia? You have to understand, my family background is actually cotton. Right? My father used to be, I think at some point, the second largest cotton trader in the world in the 80s. So I from as a baby already, commodities was a topic. So why do I say that? Because he exported a lot of cotton from Russia. And that was Soviet Union, I should say, former Soviet Union. And the former Soviet Union was the most reliable partner in commodities throughout the entire Cold War. Was there times of uncertainty and so on? Yes, but there was never a breach of contract. Putin also broke that unwritten rule quickly. Now, if you go on my tweets, you'll find some of the history of Gazprom and its bad acting, especially in Eastern Europe, from Moldova, blackmailing Moldova, Ukraine, or this or that, and so on. So they played around with the gas as a weapon all the time, but not to the major clients. Germany, Italy, UK, other Eastern European countries, Austria being a major client and so on, the hub for Eastern Europe. Now they did. They did it 18 months ago. They didn't fill the European storage, which Gazprom has, which caused us to go low with storage numbers into this crisis. And then they continued to play games, and they always said A and they always did B, except that we have data to see what they say and what they do. The classic watch what they do, not what they say thing, right? And now on top, they threaten with it, right? Medvedev the other day, the vice chairman of Gazprom came out and more or less said, well, okay, you declare economic war on us, so why don't we do that on you too? So this is the world we're in, and you're absolutely right to summarize it, that we are in a tectonic shift of how we look at this world and the globalization of it and how trade works. And what I the other day tweeted and said, we are in a world where the cheap trade, in my view, is over. Right? Are we going to trade with each other? Of course, we do in some form. I'm not so sure whether Russia long term, but at some point again, probably yes. But the short term, while Putin is around it, everyone wants to minimize that, not maximize it or keep it running. But and self-sanctioning is a big deal in what is going on right now in Europe too. So for Europe, but the point is, I think that peak globalization thing, that I would argue is definitely over in the commodities world. And there will have to be new trading routes to accommodate that market, and that's going to be a massive challenge in itself. And that always creates price inefficiency, not price discovery.
That's actually, the perfect ending, because the conversation has gone so fast, but it's been very insightful. Just like the last thing I would like you to add on is that where can people get in touch and get this knowledge? Is it just like the perfect place is Twitter? You even created a small Twitter community inside Twitter. So is the best way for people to get in touch is to use Twitter, or do you have any other preferred, media?
Well, I like to read. I on everything we try to find books that we're interesting, and I'm happy to share with your audience. Later on in your podcast, we can share some titles of books that we think that are useful. Maybe one I show, which very few people will know, but I think it's highly relevant, right? So there is a guy called Vaclav Smil, and so maybe that's what people like to read.
Energy transitions, right?
And then yes, please follow us on Twitter, and I think try to really. If commodities interest you, there has never been a better time to read up on them and reach out to us. We share ideas that we have to learn more about them. And I think if you follow us on Twitter, we are very open-minded when it comes to sharing. I think this is a world where swarm intelligence is kind of what keeps you out of trouble. And that's why I like to share my ideas. And then if someone comes and says, "Oh, you're so silly, you didn't see that," that's kind of where we can help each other, right?
Definitely. I can just say from my behalf, I learned so much from reading reports and also just following you on Twitter. So I definitely think that's a very good place to start. So maybe just say that I have many more questions, but I want to save that for part 2 in the future. So, I just want to thank you for your time, and that it was a delightful thing to have you on finally.
Thanks a lot for having me. This is the first time. Obviously, we're a small shop, but hopefully we have more of those in the future. I really enjoyed it. It was fantastic. Thanks a lot for having me.